Do we go into more debt and look at the fact that we're not really creating any jobs at home, which is currently the way that things are going and have been going for the last 10 years? Or do we try something new and something significant that could stimulate the economy and stimulate growth and stimulate business?
Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow.
Over $1 trillion of mortgages are coming up for renewal in the next 2 years, but most Canadians could care less because right now they're more focused, you're more focused on what exactly each prime minister is promising as it relates to Canadian real estate. Well, listen up because things just got really interesting because on March 30th, Pierre Poilievre made a huge announcement which not only impacts the real estate world, but also impacts the potential small business owners. Now, whether this is enough of a promise to be able to sway over those who have kind of jumped back to the liberal side of things will be yet to be determined, but it definitely was welcome news for all those small business owners and business owners in general who are sick of paying taxes on their investments. As you may know, one of the biggest challenges for Canada in the last 10 years has been a massive dip in GDP. Our country as a whole has been nowhere near productive as many of the other countries in the world and substantially less productive than it has been in the past. And Pierre Poilievre's promise to reduce or eliminate capital gains taxes for Canadians is a welcome sign of relief for those trying to keep more and more of that Canadian money in Canada. Now, before we go too far down that road, it's important to note that there have been some other changes in this campaign trail. And although this actual video was not meant to be overly political, the nature of what's going on is very political. So let's get right into it today. Let's give you some historical context to exactly how the current version of the capital gains taxes actually work. So let's say you bought a property in 2012 for $100,000. And in 2015, you were planning to sell that property, 2025, I'll say, you were planning to sell that property for $600,000. What that means is $500,000 of that property is now subject to capital gains. And under the current rules, 50% of that is taxed. Now, I don't know if you're aware of this, probably if you're listening to this, but under the most recent Liberal government, they were about to increase that to 66% for corporations, or anything over 250 grand would have been taxed at 66% for regular Canadians. So getting rid of this tax altogether is pretty substantial, but back on track. So that means that 50% of that $500,000 or $250,000 would actually be taxed under the current rules. Under the potential proposal from the Conservative government, we would see that tax completely wiped off the board for both businesses and people who own real estate investments or other investments for that matter, because it wasn't broken apart as to whether or not it was specifically only for real estate investing or for small corporations. Now, the key to this is the concept is that they're not actually eliminating the tax altogether, but what they are doing is suggesting that instead of eliminating the tax, they're suggesting that Canadians take those investment funds and actually distribute that into another Canadian investment. So under the old rules, you pay the tax. Doesn't matter what you do with it. Under the new proposed rules, which would take effect in July of 2025, what would actually happen is your actual tax amount that you would be taxed on, if that was still going to be 50%, would be eligible for something like the 1031 exchange in the United States. We'll explain that more later. But basically, you'd be able to take that money and reinvest it into another investment that qualifies. What qualifies, who knows? Prospectively speaking, if you're selling real estate, you would most likely be able to buy other real estate, and it would qualify for an exemption on the taxes. That would be massive news, and it would do a number of different things. One of those things would be that it would free up a lot of real estate in many different areas. The second thing is it could have the potential to allow for investment back into real estate, which would allow for more development. The biggest issue that we have in Canada right now is money leaving our country. One of the biggest issues for that matter. The second one, as it relates to real estate, is a lack of supply and very little reason for people to continue to stimulate and purchase or build more pieces of real estate. By reducing the taxes payable and making sure that Canadians are putting their money back into Canada, it stops them from taking the money to Mexico or the United States or any other country, and in fact incentivizes people to reinvest in our economy, which is actually what we need. So, thinking about that same scenario, with this exact same circumstance, instead of being taxed at 66% or 50% under the current regime, you would not get taxed. And of course, what would happen is you would have to just reinvest that money. Now, under the most recent guideline changes, which would have had Canadians actually pay 66% taxes, there was a suggestion that the inclusive cost of capital for large companies would be about 5%, which would have been potentially reduced Canada's overall GDP by $127 billion. Now, Carney and the Liberals have already proposed that they're going to eliminate that tax. So, as it stands right now, there would be no change to the capital gains, but the damage was already done. Under the new rules, they would eliminate that tax, therefore potentially stimulating our economy by billions, if not potentially trillions of dollars, while incentivizing Canadians to keep their money here at home, which we suggested. Now, there's been a lot of talk lately about this not actually positively impacting the supply side and mostly focusing on the demand side, which is a fair suggestion, or in some ways could make sense, because obviously a business owner who is selling off an asset or selling off a piece of real estate may choose to reinvest that money in Canada. But what that does is that frees up that current asset for anyone to purchase, whether that be a homeowner or potential homeowner, and it allows them to reinvest that money into other things such as development or other rental stock, which would be good for the economy as a whole. Now, we talked about the US's version of this just recently, which is the 1031 exchange. Let's break that down for a second. In the US, the IRS code section 1031, it allows investors to defer paying capital gains taxes on the exchange of like kind properties. So this is focused specifically on real estate in the US, provided the proceeds are reinvested in similar properties within a specified time frame. The deferral itself facilitates the continued investment and growth of capital within the real estate sector. Now, if we were to think about this for a second here, I did some research and I went into the economic impact. The studies in the United States have shown that like kind exchanges under the 1031 stimulate economic activity, and there's meaningful proof. For example, the exchanges have been associated with the creation of approximately 900, almost 1,976,000 jobs, and added a value of $97.4 billion to the US economy alone. Now, we are aware that there is a substantially larger population in the United States. But if you think about that one example right there, $1 billion to the US economy, would it not make sense to consider a version in Canada that was similar to that? I think yes. Now, who would benefit from this? Really, is the question that most people are asking. Obviously, a wide range of investors, from individual property owner investors to large scale commercial entities. There would be a massive amount of investment and benefit in the small business community. So that's not likely to have a massive impact on the average Canadian upfront, but the long game, there would be. If you stimulate real estate investment, you stimulate growth, which stimulates supply. And when you stimulate supply, what happens is it provides more opportunities, more options, and a little bit of a lower price ceiling, meaning essentially that there's going to be less price increases because you're creating more supply for people to purchase in the first place. There's this misconception out there that investors are all bad and they're out there to ruin the Canadian housing market, which unfortunately there probably are some people like that. But for the most part, that's really not the case. The average investor is a good thing. They're the reason that towers and buildings and so forth actually get built. And they're the ones who take on the initial risk because they're investing into hundreds, if not tens of units that are going to be built that the average Canadian can live in and call a home. So, what would the potential impact be on Canadians? While Canada does not really have a current direct equivalent to the US 1031 exchange, the maintenance of the 50% capital gains inclusion rate offers a relatively favorable environment for real estate investors. But the absence of any kind of deferral mechanism anywhere in Canada at all means that Canadian investors may not really experience the same level of tax deferral benefits. So we'll have to wait and see what that looks like if and when they do bring this into fruition. The discussion around capital gains in Canada definitely could and would likely be they would likely take what is happening in the United States and use that as a consideration for the basis of this capital gains exemption and how that actually works. But we'll have to wait and see exactly how the deferral works, how it's tracked, where people can move their money. Some interesting thoughts I had when I was considering the different ways that the average Canadian can actually use this deferral program and how it can benefit most Canadians. If you're looking to free up real estate to reduce the cost of housing, because a lot of people, the first argument is that by doing this, you're only helping investors. Okay, well, let's think about it from the average Canadian perspective. If we see homeowners who own secondary piece of real estate as investments, of which I've seen many Canadians that have hung on to real estate for years and years and years because they don't see the benefit in selling it anymore because it's going to cost them more money. This could potentially free up their money to put into some form of an RSP or other tax-free savings account, therefore freeing up those pieces of real estate for other Canadians to purchase and live in because they no longer want the maintenance or the problems associated with owning that real estate. The other thing that I considered is that if this is not only for real estate, but if it is also for small business, then again, the incentive is not to take my money and invest that money into a business outside of Canada, but in fact, to actually keep it and reinvest it into whatever Canadian types of investments there is. And that can stimulate growth on the large corporation level and on the small corporation level in such a significant way. I'm a Canadian business owner. I own a mortgage company. I also run a coaching program. And through that, I've wondered for years and years, as someone who also owns real estate in Canada, not wondered this, I've seriously considered the possibility of moving some of my corporations and companies, the ones that are allowed, of course, down to Mexico or the United States and other places that are more favorable after studying a lot of these tax rules and considerations. And while I recognize the pros and cons associated with moving this to another country or to another city, the pros in the last couple of years have been very significant. Someone asked me today, they said, how many Canadians are actually moving their money out of Canada and in real estate in specific? Well, I thought right off the top of my head, without even going that far, anecdotally, out of my own clients, I have clients who owned tens and tens of properties that were midterm and long-term rentals, which were sorely needed and still sorely needed at this point right now, who sold off almost their entire portfolio over the last 3 to 5 years and moved that money all down to United States, in places like Austin, Texas, and so forth, that are seeing significant growth margins. You don't think that money would be better served in our country? And in fact, someone I know, I was speaking to the other day, who runs a nine-figure company, is taking their company and basically moving the entire operations down to the United States. And a big part of it is our tax rules and laws and regulations. And you can argue about whether or not they're doing things right down there. The point isn't what's happening in the United States. The point is what's happening here at home. And whether or not you agree with the way that this is being done, you need to respect the fact that this could cause or could positively impact our Canadian housing market and investment market in so many ways that I haven't even thought about yet. Now, again, there's going to be many people out there who suggest that these campaign promises haven't been thought about very well, and they're shifting from their previous considerations of attacking Trudeau and not really sure where to go with Carney. But let's be honest here. The one reality that we're facing here is that the choices as a Canadian right now are very limited and not very positive. Do we go into more debt and look at the fact that we're not really creating any jobs at home, which is currently the way that things are going and have been going for the last 10 years? Or do we try something new and something significant that could stimulate the economy and stimulate growth and stimulate business? Now, from one side to the other, again, I'm not going to get overly political, although I have to in this general conversation. I think most Canadians should seriously consider the positive benefits associated with this type of a rule. Now, of course, most of my listeners are focused on mortgages and real estate. And so obviously, if you're someone who's focused on real estate and you'd like to be invested in some capacity, then this is obviously going to be something that significantly impacts your decision as far as going out to the voting box and considering how to vote with your money. Now, I'm going to shift gears because literally only hours after this was announced, Jagmeet Singh, the leader of the NDP party, came out with his version of what would basically be the NDP's response to this particular policy, although not really. He came out specifically, and I'm going to pull out the news on this, and said they're going to provide low rate offerings to first-time home buyers to help Canadians buy homes. But here's the thing that's wrong with that. Not that I'm inherently think that's bad that Canadians get low rate offerings, but it's three things. Number one, it's subjective, meaning what's considered a low interest rate, because what someone might qualify compared to what another person might qualify might not really be any better. The second thing is right now, if someone were to be offered a rate, let's say 1% lower than the marketplace, they still have to qualify at the qualifying stress test rate or the qualifying rate, which is a minimum of 5.25 or 5.35% in that range, anyways. And the third thing to consider is obviously that just like all of these things will be funded by taxpayer dollars, to be able to get first time home buyers into the marketplace is that is a demand question. That's someone saying that we're going to reduce increase demand by offering you a lower interest rate. So multiple problems associated with this. One, it's a free market, so what rate they choose would go down. That would definitely help the bottom line, but it's not really going to do much more than potentially increasing qualification, which we've already seen addressed with the 30-year CMHC rules. The second thing is this also assumes that this is a CMHC program, which means it is here to help home buyers, first-time home buyers who are putting less than 20% down based on the way it reads. And the third thing is it basically says we're not going to help large corporations. We support people over the profits. Now, I agree with supporting first-time buyers. I agree with getting them into the marketplace. I think it's harder than ever. You need almost two incomes to get into the marketplace in anywhere around the Greater Vancouver area, Greater Toronto area. But this almost seems even less thought out than any of the other NDP or any of the other promises that are out there for that matter. And I'm struggling to understand specifically how this will help first-time home buyers. Now, some of the quotes from Jagmeet Singh, unlocking the power of the financial power of CMHC. He says, in this election, the question is simple. When Trump's tariffs hit and costs keep rising, who will stand up? While Carney and Poilievre side with the banks, speculators, and the same market forces that caused the crisis, NDP are fighting for families who just want a shot at owning a home. He says, for decades, CMHC offered a preferential financial tools to help big developers create rental projects while first-time homebuyers are left behind. Singh's plan will expand CMHC's mandate to serve the people it was originally built to help. Now, I will say a few things. Number one, the CMHC's mandate is many different things. Not only to help Canadians own homes, but it is a large part of it. And where it's going right now is to help the supply side. There's no doubt about that. And there are definitely a lot of issues associated with the current version of CMHC's current plan and how they operate. However, suggesting that a 0.5% reduction in interest rates is going to massively stimulate first-time buyers to get into the housing market, to me, is not the way to do it. There are so many other mechanisms that they could use to do this. Like, let's look at our stress test, for example. And by no means am I saying we should have no version of stress test or no protect, but why don't we just look at the stress test as a consideration of saying, well, what if we eliminated the stress test for well-qualified first-time home buyers, or reduced the stress test for well-qualified first-time home buyers, or just looked at some version of that as one of the primary ways to get in based on a credit score or a certain of assets or a job profile. One of the biggest challenges for first-time home buyers isn't necessarily always just the income. It's actually getting the down payment money and then qualifying. Qualifying is the number one reason that first-time home buyers sit on the sidelines more than anything else. And so if we think about these different programs, whether it be Carney's version, which is to say, hey, we're going to give you up to $1 million, any new development property up to $1 million, we're not going to put GST on it. Well, the developers are just going to bake GST back at the price. So whatever. The variation of Pierre Poilievre saying we're going to do no GST on new properties up to 1.3 million, reasonable from a home price perspective. But again, the problem with that is the developers are just going to continue to bake the GST into it. So it's not going to help the Canadians. It's going to help the developers. Now, I do believe that developers do need a little bit of coaxing. They do need some support, but I think a lot of that just comes down to the cities and the municipalities and all the crazy fees that they charge down at the municipal level to get into the marketplace. Now, there's going to be a lot of new changes and different regulations that are going to come into effect over the course, or not regulations. There are going to be a lot of promises that are going to come into effect over the course of the next 30 days. Things are just beginning and they're about to get very wild. So what I recommend for any Canadian who's listening to this, while I don't recommend taking everything that I have to say as the gospel, I recommend you do your research and don't just watch YouTube and don't just go on one place. Look at multiple sources. Make a decision based on the facts, make a decision based on what you know. I think you should really understand the state of the economy, particularly as it relates to what's happening with our GDP and where we are right now, economically speaking. Understanding that There's multiple different factors at play, notwithstanding what's going on in the United States with the tariffs and what's going on there. We're dealing with a lot of stuff at home. And I think most Canadians are not really paying attention to the big picture and how positively impactful reducing income taxes could be in this regard to stimulate our economy. Most people are worried about a small handout. I think we should be focused on the bigger picture, because if we can increase the spending in our economy, we can bring companies back, we can bring people back, and this will actually help us in the long haul as a country. I'd love to hear from you today. Are you a fan of any of these new announcements, whether it be the new GST, whether it be the property transfer tax exemption, or anything else? And if you're a Canadian homeowner or someone looking to get qualified for a mortgage and want to work with myself or my team here at Flow Mortgage Co., we specialize in helping Canadians qualify for better terms and be able to optimize their current mortgage to reduce their overall interest. Go ahead and click the link below if you want to find out more about us. If not, we'll see you on the other side. Thanks for listening. Leave us a review. Talk soon.